So for those of you who are attending the class for the first time, my name is Luqman Rafiq and I'm the tutor for this paper AFM. We started discussing about the AFM around, we started off with the classes for this March attempt, and just 1 or 2 days before the result, we took a break and we are back again now. So let me give you a bit of a guidance that what am I going to be doing and what is the schedule of the classes that we shall be following. So let me get you through some of the specific topics that I will be doing and how I will be covering those topics. So first of all, let me guide you that we are going to have 3 back-to-back classes today, tomorrow and day after tomorrow. And after those 3 classes, we'll have the class every third day. After those 3 classes, we are going to have a class every third day. And the objective of the class is going to be that we shall be discussing about the different aspects of the AFM. So let me have a quick overview of the major areas that are covered up in the AFM. I have discussed them earlier also in my earlier introductory video, but anyways. So I told you people earlier also that these are the 3 major areas in the AFM. And what are those 3 major areas? That is advanced investment appraisal. In fact, 4 major areas: advanced investment appraisal, the mergers and the acquisitions, the corporate reconstruction and reorganization, and the treasury and advanced risk management technique. So what I'll be doing is my objective of today and tomorrow's session and the day after tomorrow's session is I'll be covering these 2 areas, which is going to be acquisition and merger and which is going to be the corporate restructuring and reorganization. And once we are going to be done with these 2 areas, so what we will do then is we will then move a bit forward and we will have classes after them, and those classes would feature the other areas of the topics. What are those other areas that those classes would feature? So let me guide you with respect to it. So first of all, let me share the schedule with you, the schedule that I shall be following for those other classes. Um, in fact, I've shared with you people over the WhatsApp group also, but still, I'm just going to share it here just to give you an idea that how exactly would I be proceeding with my discussion. So you have in front of you the schedule. This schedule actually tells you that what are going to be the class timings. We'll be having class today, tomorrow, and day after tomorrow. Then we'll have class every third day, which is 3rd Feb, 6th Feb, 9th Feb, 12th Feb, 15th, 18th, 21st, 24th, 27th. This is how we'll have our classes. And when we shall be having our classes, so there is something that you need to keep in mind, and that is basically in these classes, I mean, like these first 3 classes, I'll be going through the basics of valuation and corporate restructuring and reconstruction and some of the past papers question on these. And these classes would be made available to you people on the YouTube channel of Escribir. After that, these classes would be conducted. I'll tell you about the topic in advance that you have to come up and study. And what I'll be doing is I'll be having a quick recall of the topic in these classes, and I'll be doing the exam questions pertaining to these topics. So this is how we will go about till the end of the examination. I mean, like till the end of this specific paper. So for those of you who actually are having access to the lectures on our Scribers portal, let me guide you something with respect to how these lectures are arranged and what are the things that you could do with respect to these lectures. So with respect to the lectures, the way they are arranged, um, you have this website, the name of which is scriberacademy.com. You go onto this website, there is this courses which are the courses of AFM English language. Okay, now when this is the course that is available, you can see that this is this introduction. Then what I did was I discussed the VAC area with all of you during the class. After the VAC, I talked about the bond yields and the bond valuations. Then there was this investment appraisal basics, which I haven't covered up. I'm just going to be relying upon the recorded lectures for it. Free cash flows, we went through them. We went through the concept of transfer pricing also. This is something that we have done. So up till now, I mean, like this is what we have covered up till now from here till here. And in this, investment appraisal is something that you have to do through the recorded lectures. But I'll be going to mergers, acquisition, restructuring, reconstruction, and then I'll tell you about the topics that I'll be covering later on. So that's it about the bit of an introduction about how we are going to take about this AFM fast track classes. So let's just start off the topic that we shall be discussing today. This topic is the mergers and acquisition. What is this topic? The name of the topic is mergers and acquisition. Now, if I talk about the concept of mergers and acquisition, let me guide you a few things. That what are the things with respect to merger and acquisition that are examined, and how exactly are these things examined? So what happens is, the first thing, if you as an organization want to grow, I repeat, if you as an organization want to grow, so there are options for you to grow. Either you go for the organic approach of growing, or you go for the acquisition or the acquisitive approach of growing. I repeat, if you as an organization have to grow, then what do you need to do? You need to either grow in the organic way, or you need to grow with the acquisition. When we talk about the organic method of growing, so what exactly do you mean by organic? So the concept of organic growth is slowly and gradually you keep on reinvesting the fund. You keep on reinvesting the fund. You keep on growing the branch one by one by one by one, and so on and so forth. And you keep on growing your business. The advantage of this organic way of growing the business is that when you grow the business in an organic manner, am I audible clearly? Testing 1, 2, 3. Okay. Okay. So what we are talking about is that when we talk about the organic way of growing a business, so the organic way of growing the business would actually mean what? The organic way of growing the business would actually mean that you have a growth which is controlled, which is under your control. The growth is steady, but the problem is that the growth is going to be slow. But the problem is that the growth is going to be slow. So a lot of business, what they want is they want to grow, but they can't, but they don't have the time to grow at a very small pace, at a very slow pace. So what they do is that they go about, the acquisitive approach of growing. I repeat, they go about acquisitive approach of growing. And when you talk about the acquisitive approach of growing, so what you could do is that you can have a different type of acquisition. You can have different type of acquisition, and the different type of acquisitions are actually termed as this vertical integration. This is actually termed as horizontal integration, or the horizontal acquisition. And the third one of them is actually termed as what? The third one of them is termed as diversification. So basically what happens is, a lot of business, what they do is that they grow, and when they grow by acquisition. What exactly do you mean by growth by acquisition? So growth by acquisition is you acquire an existing player. You acquire an existing player. And how do you go about acquiring an existing player? So the growth could be in the form of vertical integration, could be in the form of horizontal integration, or could be in the form of diversification. What exactly do you mean by this horizontal vertical diversification? So when we talk about the vertical integration could be of two types. And what exactly of those two could be two types? Upwards and downwards. What exactly do you mean by upward and downwards? So assume that You are a manufacturer of product. Again, you are a manufacturer of product. If being a manufacturer, you acquire a retailer, that means you have gone for a downward vertical integration. If you are a manufacturer and if you go, let's say, to the producer of raw material, if you go and acquire the producer of the raw material, that means you've gone for an upward, acquisition. When we go for the upward, this is also going to be termed as if you are becoming your own supplier, becoming own supplier, becoming own supplier. And when you go for the downward acquisition, what you do is that you become your own customer, become your own customer. So basically what happens is when we talk about the integration, when we talk about the acquisition could be vertical form. The acquisition could actually be horizontal form. What exactly do you mean by horizontal form of acquisition? So when it comes to horizontal form of acquisition, that means in the same line of business. That means in the same line of business. You are producing milk. Now you have acquired a company that produces tea whitener. You are producing milk. You have now acquired a company that was producing tea whiteners. So if you have acquired a company that was producing tea whitener, they are your competitor, but they are not your supplier. They are not your customer. They are your competitor, but they are not your customer. They're not your supplier. So if you make an acquisition like this is going to be termed as what? This is going to be termed as your horizontal integration. And the third one of them is basically termed as diversification. The third one of them is termed as diversification. Well, basically what happens is the diversification could be a related diversification and could be an unrelated diversification. One of them could be a related diversification. One of them could be an unrelated diversification. What generally happens with respect to diversification is that, generally speaking, the diversification is when you enter into a new industry, where enter into a new market. So that is actually generally considered to be a direction. You enter into a new industry, you enter into a new market. Like for example, you were a tea manufacturer. You were a tea manufacturer selling your tea in UK. Now what you have done is you have started to produce the milk powder. You have started to produce milk powder, and the first country whom you are going to be selling the milk powder is China. So that means what happens is you have entered into a new industry and you have gone on to explore a bit altogether new market. So this is going to be considered as your unrelated diversification. This is going to be considered as your unrelated diversification. What exactly do you mean by this unrelated diversification? That means it's one of those diversification which is not connected to your previous activities. It's one of those diversification which is not connected to the way you are operating right now. So there could be a related diversification, there could be unrelated diversification, but simply what happens is you go to an altogether different area. You go to an altogether different industry, you go to an altogether different market. That is what the diversification is. So that is what it actually exists. Now, this is unrelated diversification. Okay, just wait a bit. You were manufacturing textile. You were a textile producer. And now what you have done is you have acquired a bank. So what happens is, where is this textile and where is this bank? I repeat, you are a company who was operating this textile. You were a company who was operating textile. And when you were a company who was operating textile, so resultingly what happens is if you have now gone on to operating a bank, so that's an unrelated diversification. It's one of those diversifications which has got no connection whatsoever with your existing business. That is what the unrelated diversification is going to be. So generally speaking, what happens is whenever we go for the acquisition could be different types. It could be vertical. It could be, and the related is going to be textile to textile, but a different line of business with respect to textile. So let me come back again. When we talk about the acquisition is You grow your business, you acquire an already existing player in the market. We know a lot of acquisition examples in this world, and the many acquisition examples have been recently. What has happened in UK is there was a brand which was Debenham, and it has been acquired by, I think the online retailer's name is Boohoo. So Boohoo has actually acquired Debenham. Secondly, what happens is there is actually Cadbury company. Cadbury company has been acquired by Kraft Foods. So Cadbury company has been acquired by Kraft Foods. That's also another acquisition. Then what we have is we have this acquisition of WhatsApp. WhatsApp was being acquired by who? WhatsApp was acquired by Facebook. So overnight, Facebook had a substantial amount of customer base. Then we had this Nokia. It was acquired by Microsoft. So Microsoft acquired Nokia. What benefit is this Nokia giving to Microsoft? It was not present in the mobile phone industry. Its competitors were present, so it wasn't present. So it automatically became what? It automatically had a chance to show its presence in the mobile phone development segment. So generally speaking, what happens is when we talk about this specific area, that the acquisition. So a lot of companies practically they go for acquisition, and the major reason for going for the acquisition is that the acquisition helps you grow. The acquisition helps you grow. What happens is the acquisition helps you grow. Now, how does acquisition helps you grow? The growth through the acquisition is actually like this: that overnight, overnight you get hold of products. Overnight you get hold of customers. Overnight you get hold of the distribution channels. Overnight you get hold of brands, etc., etc. A lot of things, actually, you end up getting a lot of things overnight. So when you end up getting a lot of things overnight, so what is it actually going to be? This is going to be considered as the benefit or the advantage of acquisition. This is going to be considered as the benefit or the advantage of acquisition. Now, let's move a bit forward and let's discuss further. The next aspect of this specific acquisition is what? I repeat, the next aspect of the acquisition is that um, there are obviously multiple problems with respect to the acquisition. I repeat, there are multiple problems also with respect to the acquisition. And what are those problems? The problems could be the integration of the business which you are acquiring, the duplication of functions. I repeat, it could actually be integration. It could actually be duplication of functions. Then if we go about, there could actually be what? So the integration, at the same time, cultural issues, etc., etc. These could be multiple things that you could come across when it comes to the acquisition. Although it's advantageous, although it's something that gives you the benefit, but at the same time, this is also something that is going to be considered as what? A problematic situation. Now, why is it actually going to be considered as a problematic situation? The reason being, I repeat, the reason being that there could be multiple issues that can arise with respect to this specific acquisition. Now, if I talk from the perspective of the exam, if I talk from the perspective of the exam, so what exactly is going to be the things that we need to be considering with respect to this mergers and acquisition? So there are four important things which you need to consider with respect to merger acquisition, which is going to be the valuation. The second thing is that which business to acquire. The third one of them is going to be how to finance the acquisition. And then what happens is what could be the possible issues that can arise with respect to this acquisition. I repeat, what could be the possible issues that can arise with respect to the acquisition. So all of these things need to be considered. And the most important aspect of all of them is the valuation. And the most important aspect of this is going to be considered as valuations. Are you people okay with this? Anyone having any question, please? Yeah, are you people okay with this? Anyone having any questions, please? Okay, good enough. So what have we discussed? What have we done? We have actually talked about the concept of mergers and acquisition. We have talked about the basics with respect to mergers and acquisition. That what are the things that we can expect from the examiner, and how exactly are we going to tackle them? That is something that we'll discuss. But for the time being, you try to understand that what is it that you can expect from the examiner. Now, let's move a bit forward and let's discuss further. So the first thing that I'm going to be talking about is the valuation. I repeat, the first thing that I'll be talking about is called the valuation. When we talk about the concept of valuation, there are multiple things that you need to consider. That whenever we value a business, there are multiple ways of valuing a business. And what are those different techniques? The different techniques are asset-based valuation. The different techniques are income-based valuation. And the third one of them is termed as cash flow based valuation. So when we acquire a business, there could be the different techniques for acquiring a business, for purchasing a business. And what could be those different techniques for purchasing a business? You can use asset based valuation, you can use income based valuation, you can use cash flow based valuation. What exactly are these valuation methods? So we are going to discuss them one by one. The first one of them is termed as the asset based valuation. I repeat, the first one of them is termed as asset-based valuation. When we talk about the asset-based valuation, so let's try to understand that when you acquire a company, the balance sheet of the company has got what? The balance sheet of the company has got assets. The balance sheet of the company has got liabilities. I repeat, what happens is whenever we acquire a company, the balance sheet of the company has got assets. The balance sheet of the company has got liability. You deduct the liabilities out of the assets. So what do you end up getting? I repeat, when you deduct the liabilities out of the assets, so what do you end up getting? This is actually termed as net assets. I repeat, when you acquire a company, so what actually happens is, resultingly, what do you end up getting? You end up getting the net asset. So always remember that when we are talking about the asset-based valuation, I repeat, whenever we are talking about the asset-based valuation, so the asset-based valuation actually means net asset-based valuation. I repeat, whenever we are talking about the asset-based valuation, the asset-based valuation actually means net assets-based valuation. And what do we mean by net assets-based valuation? That means assets less the liabilities. That means assets less the liabilities. Now, when we talk about the asset-based valuation, there are multiple variants to the asset-based valuation. I repeat, there are multiple variants to the asset-based valuation. What are those multiple variants to the asset-based valuation? The first one of the variant is that you use the net book value approach. What happens is you use the net book value approach. Now, what exactly do you mean by the net book value approach? The net book value approach means that whatever the balance sheet carrying amount of the assets and liabilities, what you do is that you establish the value of the business on these bases. I repeat, what you do is that you establish the value of the business on these bases. What is that? That is basically the net book value based approach. What happens is you value a business on the basis of the balance sheet asset values, balance sheet liability values. That's what you do with respect to the net book value approach. So when I talk about the concept of net book value approach, remember this thing, that what happens is you value the business using the carrying amount of assets and carrying amount of liabilities. When we talk about the net book value based approach, so are there any benefits of it? Are there any problems with it? Well, basically what happens is it is one of those valuation method which is simple and which is easy to use. But the problem is what happens is that the fair values of the assets and the liabilities are not reflected. I repeat, it's actually the fair values of assets and liabilities are not reflected. That's the one thing. So what actually happens is the fair value of the assets and the fair value of the liabilities are not reflected. That's the first thing that happens. What else happens is that the next thing that actually happens is um, so I repeat, what happens is the fair value of the assets or the liabilities and the liabilities are not reflected. The second thing is that any unrecognized asset, any unrecognized liability, that is also not reflected. Any unrecognized asset, any unrecognized liabilities, that is also not requested. So what happens is whenever we talk about the concept of net book value based approach, the concept of net book value based approach is very simple, which is all that you have to use is that you have to use the balance sheet carrying amount of the assets. You have to use the balance sheet carrying amount of the liability. You have to use the balance sheet carrying amount of the asset, the balance sheet carrying amount of the liability, and on the basis of those balance sheet carrying amount of the assets and liability, that's what you do. Okay, let's move a bit forward and let's discuss further. I repeat, let's move a bit forward and let's discuss further. So the next thing that you need to understand with respect to it is that, um, so what happens next is that one of the ways of valuing a business is what you do is you use the net book value. I repeat, one of the ways of valuing a business is that you use the net book value. And you actually value the business on the using the net book value, but obviously there are problems, obviously there are issues with respect to net book value. And what I have done is I have actually discussed them with you people, that what exactly are them now. So this is one of the aspects that, in case if you wish to value the assets using value a company using net asset based valuation, the first one of them is net book value. The second method is called the net replacement cost. The second method is called net replacement cost. What exactly do you mean by the net replacement cost? The net replacement cost actually means that if I need to purchase the similar type of assets from the market, if I need to purchase the similar type of assets from the market, how much are they gonna cost me? How much are they gonna cost me? What is gonna be the value of these assets? So like for example, whatever the assets that you have, you actually establish the current market value of those assets. Now, always remember something. When you buy an asset, there's a different price applicable to it. And when you sell an asset, there's a different price applicable on it. So generally speaking, the price that we pay for the buying of an asset is called the entry price. And the price that we receive for selling an asset is going to be considered as what? Exit price. I repeat, what happens is the price that we pay for the purchase of an asset is going to be considered as entry price, and the price that we pay for the selling of the asset, that is going to be considered as an exit price. Now let's move a bit forward and let's discuss further. So basically what happens is when we talk about the concept of net replacement cost, I'm telling you people that the net replacement cost actually means if you wish to buy the same asset from the market today, what is the price that you will be paying in the market to buy these assets? The price that you will be the price that you will be paying in the market to buy these assets, that is going to be considered as the replacement cost. So all of the current market value, which is the entry price of the asset, which is the entry price of the asset, that is going to be considered as your net replacement cost. That is, if I have to replace all the assets, if I need to buy a similar type of assets from the market, how much am I going to be paying? Okay. What is the advantage of this? The advantage of this is that you now end up getting the fair values. I repeat, the advantage of this is that you now end up getting the fair values. And the problem is that the disadvantage is that if fair value is not available, then valuation is affected. If the fair value is not available, then the valuation affected. I'm sorry, my writing isn't good, but that's why when I say while writing, so I think you are able to understand well. So basically what happens is when we talk about this net replacement cost, so you need to keep this thing in mind that whenever it comes to this net replacement cost, the net replacement cost would actually means that you are using the market value of the assets for the purchase. I mean, like you are establishing the entry value of the assets, and on the basis of entry price, you are establishing the total value of the business. The third one of them is called the net realizable value. The third one of them is termed as net realizable value. When we talk about the concept of net realizable value, so what exactly do you mean by the net realizable value? The realizable value actually means if all the assets are sold, if all the liabilities are settled, if all the assets are sold, if all the liabilities are settled, the price that you're going to get, that is going to be considered as net realizable value. The price that you will get for the selling of the assets, the price that you get for the settlement of the liabilities, that is going to be considered as net realizable value. Now try to understand this thing. What you need to understand is that um, as I told you a bit earlier, this is actually going to be considered as your exit price. This is not going to be the entry price. This is the exit price. That is, if I have to sell these assets right now, what is going to be the price that I'll be fetching? Edna Fadero, your question, if fair value is not available, what happens? Unfortunately, you try to estimate the fair value on your own. Even if the estimation cannot be done, then what you do is that you just do the rough workings. I mean, like you can use the book value for the valuation. So what actually happens is this is considered to be net realizable value. That means if all the assets are going to be sold, the price that you will fetch for selling the assets. If all the liabilities are going to be settled, the price that you will get to settle the liability, all of them is going to be considered as what? Net realizable value. Now, let's move a bit forward. Let's discuss further. So I've told you people that what net realizable value approach is. Now, what is the best approach amongst all of them? Should we go for net book value? Should we go for replacement cost? Or should we go for net realizable value? I repeat, what should be the value? Should it be the net book value approach? Should it be net realizable value approach? Should it actually be your net realizable value approach? What is the approach that we shall be using? So what happens is it actually depends. No, it actually depends. For example, if you have got a business whose fair value are almost equivalent to the book values, then this is okay. If you have got an asset uh, and you were planning to set up a similar business, so you would go for replacement cost. For example, if you're going to buy the business and you will break it up means you will sell its assets. You will sell its assets, you will settle its liability, or you would keep some of the assets for it. So what you would do is that you would go for the breakup. So generally speaking, the breakup value isn't used where there is a going concern issue. I repeat, the breakup value is not used where there is a going concern issue. I repeat, the breakup value is not used where there is a going concern issue. Do you get it now? Yeah, are you people okay with it? Are you people okay with it? Okay. For example, if you have acquired a business and you don't think that you can continue running that business. I repeat, if you have acquired a business and you don't think that you can continue running that business, and all that you have to do is that you have to split that business. So that means that you're going to be closing that business. Okay, Jihane, with respect to net realizable value, again, the same thing is that you actually value the business's assets at the value that they would fetch, in their present condition. So it's a more realistic approach. I mean, like, it's close to the fair value approximation. But again, it's not always the case. Maybe as a business, you might not want to sell out the asset. If you value on the uses on the basis of net realizable value, you are valuing on the basis of net realizable value, but you don't intend to sell it. I repeat, you are valuing on the basis of net realizable value, but you don't intend to sell it. So when you don't intend to sell it, that means that it is going to be a wrong valuation. So basically what happens is, when we talk about the asset-based valuation, these are the different types of asset-based valuation. Now, which of the method is the best estimate? So it's actually depending upon the circumstances, but generally uh, there are few things that need to be considered, which is ideally the fair value should be used. And also you should try to ensure that what you do is that you record the unrecognized asset and liability. And another important thing is that you try to recognize the unrecognized assets and liability. That is also an important thing to be considered. Yeah, are you people okay with it? So basically what happens is, ideally what should happen is you should recognize them at fair value. The second thing is that the unrecognized assets and liabilities should also be recognized. So usually what happens is, it's majorly the intangibles. I repeat, it's majorly the intangibles that are not recognized. So if it's majorly the intangibles that are not recognized, um, yes, they are all asset-based valuation, Jihane. They're all asset-based valuation. So basically what happens is, majority of the cases, the intangibles, they are not valued. So what you need to do is that you need to adopt a valuation method for intangible. So there are valuation method, like for example, if there is a brand, you need to value the brand. If there is goodwill, you need to value goodwill. If there is a customer list, you need to establish the value of the customer list. All of them, what are they going to do? They're going to actually tell you, I repeat, all of them, what are they going to do? They are actually going to tell you that there are different methods, and amongst the different method, one of the most common method is called calculated intangible value, which is actually called the CIV method. There is one method which is called calculated intangible value. What is calculated intangible value? The calculated intangible value is called CIV method. The calculated intangible value is called CIV method. Okay, So what we have done now is we have discussed about the valuation technique, that in case if you wish to value a business using the asset based valuation, what are the things, what are the different methods, what are the different approaches that you can adopt in order to value your business using the asset based valuation. Let's move a bit forward, and now the next thing that we shall be discussing is called the income based valuation method. So if I talk about the income based valuation method, as the name suggests, that these are those methods which are based upon an entity's income. As the name suggests, these are those methods which are based upon an entity's income. So when we talk about the income based valuation method, Abdullah Hussaini, don't worry about it. I'll go through the calculated intangible value. When we talk about the income based valuation method, let's try to have an understanding. The income based valuation means that you are talking about a company's income. And when we say income, the income actually means profit. The income actually means profit. So that means you're talking about a company's profit and valuing the business on the basis of the company's profit. There are majorly two methods with the income based valuation method. One of them is called PE ratio based valuation, and the other one of them is termed as earnings yield method. What is this PE ratio based valuation? What is earnings yield method? So let me explain to you people. When we talk about the P ratio based valuation, the P ratio based valuation is the first method that we'll talk about. Before I go on discussing these methods, this PE ratio means what? The PE ratio means the price earnings ratio. The P ratio means the price earnings ratio. The formula for the P ratio is what? The formula for the P ratio is share price divided by EPS. Formula for the P ratio is share price divided by EPS. When we talks about the earnings yield method, the formula for earning yield is opposite to P ratio. The formula for earning yield is opposite to P ratio. What is it opposite to P ratio? Opposite to P ratio actually means that the formula is like this: EPS divided by share price. And this is expressed in terms of percentages. This is expressed in terms of percentages. So EPS divided by share price multiplied by 100, that is what we have. Now, what are these methods? Why are they used? And how do we implement them? So let's talk about them. The first one of them is PE ratio. What does P ratio tells us? The P ratio, which is the share price divided by EPS, means what? $10. Let's say a share price of $10. Let's say EPS of $4 gives you 2.5 times. Assume that the share price is $10. The EPS is $2, so you end up getting 5 times. Assume that P ratio is $10 and the EPS is $5, you end up getting 2 times. Now, what does this mean? If I talk about this P ratio of 2.5, or if I say P ratio of 5, what does it mean? It means an investor is willing to pay $5 per $1 earnings. An investor is willing to pay $5 per $1 earning. That means the company is earning $2 and the investor wants to acquire this company's share for $10. Means for every single rupee of earning, he's willing to pay 5 times more. Why would an investor be willing to pay 5 times more? I repeat, Why would an investor be willing to pay 5 times more? An investor would be willing to pay 5 times more because he has got confidence in this investment. He is actually expecting, there is an expectation that the investor is having a confidence. There is an expectation. What is that expectation? The expectation is that the company will generate a lot in future. The company will generate a lot in future. That means there is a good prospect with respect to that company. So whenever the investor can think that there is a good prospect about a company, so he would be willing to pay more and more. So the higher the PE ratio, the greater the investor confidence is. I repeat, the higher the PE ratio is, the greater the investor confidence is. So you need to keep this thing in mind, that the PE ratio actually tells you the investor confidence. And the higher the PE ratio is, the greater the investor confidence is going to be. So what happens is, how do we, how to value a business using P ratio based valuation? How to value a business using P ratio based valuation? So if I talk about valuing a business using the P ratio based valuation, what do we mean by this? The first thing is you need to identify a proxy company. You need to identify a proxy company. The second thing is that once you have identified the proxy company, the second thing that you would do is that you would calculate the proxy P ratio. The third thing is going to be you would be adjusting the proxy PE. And the fourth step is going to be use adjusted P ratio for valuing company's shares, for valuing the company's shares. So what do you need to do? You need to identify a proxy company. You need to calculate the proxy PE ratio. You need to adjust the proxy PE. And what next you need to do? You need to use the adjusted P ratio for valuing the company's shares. Now, what do we mean by this? Let's try to have a discussion. First of all, identifying a proxy company. What do we mean by proxy company? The proxy company means similar type of company. The proxy company means similar type of company. Assume that if you are trying to value a steel manufacturer, I repeat, if you're trying to value a steel manufacturer, so what you need to do is that you need to identify a listed steel manufacturer. What do you need to do? You need to identify a listed steel manufacturer and you need to establish the value of that company. You need to identify a listed steel manufacturer. That means a similar type of company as compared to our proposed business. The next thing is you have to calculate the proxy P ratio. What do you mean by establishing the proxy P ratio? So whatever the proxy company that you've identified, all that you need to do is that you need to establish the P ratio of that proxy company. So if you need to establish the P ratio of that proxy company, so maybe let's say that this is 6 times. Let's say that this is 6 times. Now the third step is adjust the proxy P ratio. Now why would you adjust? What do we mean by adjust? Let's talk about it. Now when we talk about the proxy P ratio, the proxy P ratio would mean what? The proxy PE ratio, adjustment of proxy P ratio means what? Generally speaking, what happens is This valuation method, I am saying generally it's used to value a private company or maybe an unlisted company. Now remember, the value of a private company or an unlisted company and the value of a similar type of listed company cannot be equal. Why is that so? The reason being that the listed company has got multiple advantages. What are those multiple advantages? One of them is there is an access to finance that this listed company has. What is the other advantage that the listed company has is it's actually marketability of shares. The shares of a listed company are well known. And the third one of them is the transferability. The shares of the listed company are easily transferable to somebody else. But when it comes to the transfer of the shares of a private company, it becomes a problematic situation. So what happens is when we talk about this listed company and an unlisted company, so there's usually a difference between the value of both of these. And what are the reasons for those valuation? The reasons for those valuation is that the listed company has got access to finance because it's listed, it can raise finance, it can raise debt, it can raise equity. The marketability of the shares is higher. The transferability of the shares is also higher. So as a result of this, generally, maybe what would happen is, in practice, the books say that a similar type of an unlisted company, you would probably adjust the P ratio by 2/3, let's say. That means that the P ratio is going to be 2/3 of what the listed company's P ratio is. So if it's 6 times, so 6 times multiplied by 2/3 is going to be what? Um, is going to be 4. I repeat, what is it going to be? It's going to be 4 times. So that means you would be using this 4 times as the P ratio of an unlisted company. Okay, let's take this example. Let's take this example that you go to an area where there are multiple properties, where there are multiple properties situated. Now, amongst these various properties, what happens is all of these properties have got a specific measurement. That is, all of these properties are of, let's say, 1,000 square yards. These 4 properties are the properties which lie at the corner. So what you establish is that you establish the value of this property is $100,000. So if the value of this property is $100,000, the $100,000 divided by 1,000 gives you what? 123 gives you $100 per square yard. Gives you $100 per square yard. Now, if I tell you that the value of the property situated here is also 100 per square yard, is also 100 per square yard, is also 100 per square yard, would it be okay? Why no? Why no? Yeah, may I know the answer? Why no? Yeah, the prices in the middle may be a bit lower. Now, why is that, sir? The reason being that the property which is situated in the middle is not having immediate access to the road, is not immediately accessible property. The second thing is that when you will go for selling the property, you would not be getting a buyer easily for those properties. Even if the buyers would be found, then the buyers would not be willing to pay much amount of money for those properties. So resultingly what happens is, I repeat, resultingly what is actually going to happen? Resultingly what is actually going to happen is that when you will be buying those properties, you would not be valuing those properties at the same value. You would rather be valuing those properties at a lower price. I repeat, you would be rather valuing the property at a lower price. Is that okay to you people? Yeah, is that okay to you people? So now the same goes for a company also. Now, when we talk about the same goes for the company, so what do we mean by this? Now, how does the same goes for the company? It's something that you need to understand. What is it that you need to understand? It's actually like this, that basically what happens is that when I talk about a company, so a company which is listed would have a different value. A company which is unlisted would have a different value. A company which is listed would have a different value. A company which is unlisted would have a different value. Why is that so going to be? The reason being, I repeat, the reason being that those companies which are listed, I repeat, those companies which are listed, they have got greater access to finance. I repeat, they've got greater access to finance. And when they have got greater access to finance, so this means that the values of those companies should be higher. That means the values of those companies should be higher. But those companies which don't have greater access to finance, the value of those companies should be lower. The value of those companies should be lower. Is that okay to you people now? So that's why there is this adjustment factor. Now, a question that arises is, what should be the adjustment factor? Should we multiply it by 2 upon 3? Should we multiply it by 4 upon 5? What should we do? So it actually depends upon your assessment. It actually depends upon your assessment. Okay, so the third step was basically that we had to adjust the P ratio. We have done the adjustment for the P ratio. And once, okay, now, yes, whatever the adjustment that has to be done, it has to be given. Yes, Abdullah Hassani, I'll go through the past papers. You don't worry about them. So once what happens is we have the adjusted P ratio, we can use the adjusted P for the valuing of the company's shares. We can use the adjusted P for the valuation of the company's shares. Now you have got an example in front of you. What I want you people to do is that I want you people to go through this example, try to attempt it. Try to attempt it. Now let's talk about it. The first thing is it says an entity has a profit after tax of $4 million. How much is the profit after tax? It's of $4 million. Okay. And then its shares have a par value of 20 cents each. Okay. And what else is there? It says the total paid up capital is of $5 million. So what is the total paid up capital? It's $5 million. So if I try to calculate the number of shares, I would say $5 million divided by zero point 0.2. What am I going to do? I'm going to say $5 million divided by zero point 0.2. Why? Because what happens is you've got 20 cents as the par value, and you've got a total of $5 million of paid up capital. What have you got? $5 million of paid up capital. So on the basis of this, what do we end up getting? We end up getting uh okay, what do we end up getting? It's 5 million divided by zero point 0.2. So you end up getting 25 million shares. So there are 25 million shares of this company. So if I say the EPS of this business is going to be 4 million divided by 25 million, 4 upon 25 million gives you $0.16. That is what your EPS is. The P ratio, which is the adjusted P ratio, is going to be 6 into 80%, gives you 4.8 times. The adjusted P ratio is going to be 4.8 times. On the basis of this, the market value of the company, on the basis of this, the share price of the business is going to be what? PE ratio multiplied by EPS. It's going to be P ratio multiplied by EPS. So P ratio is 4.8 times and the EPS is $0.16. So resultingly what happens is you end up getting the share price to be what? 0.768. What do you end up getting? You end up getting the share price to be $0.768. Once we have got the share price of $0.768, the next requirement over here is that we have to calculate the market capitalization. What is the formula for the market capitalization? The formula for the market capitalization is the share price multiplied by number of shares. The share price multiplied by number of shares. And when we say share price multiplied by number of shares, so the share price is $0.768 multiplied by number of shares is going to be 25 million. So resultingly $19.2 million is going to be your market capitalization. I repeat, $19.2 million is going to be your market capitalization. Now, a lot of you people got it wrong. Why? I repeat, a lot of you people got it wrong, and that is why. Why have you people ended up getting it wrong? What was the reason behind it? Are you not able to understand it, or what? A lot of you people have got it wrong. Okay, you see, what I understand is the reason for you people getting it wrong is this specific problem, which is that you probably would have calculated the number of shares to be incorrect. You would have probably calculated the number of shares to be incorrect. That would have been one of the reasons that you people would have got it wrong. I repeat, this could have been one of the reasons that you people would have got it wrong, which is because the number of shares would have been computed incorrectly. The number of shares would have been computed incorrectly. That's what would have happened to you people. So anyways, what we have done is we have actually gone through one of the examples of where we actually computed that how we actually establish. Okay, so I hope you people get to have a good understanding of the workings and all. Okay, good enough. So it's actually, I mean, like there wasn't anything extraordinary about this question except that it was a basic recall of the old things that we have been discussing and we have been covering. Yeah, profit after I got the share price wrong, but the market correct using a different approach. Well, everything has to be, you have to get everything correct. It cannot be that you get one thing right, you have get one thing wrong. I mean, because we are in the learning phase right now. If it's exam condition, then it's okay. But if we are in the learning phase right now, you have to make sure that you get everything right now. So we are done with this P ratio based calculation. So always remember that if there is a company which is a loss making company, or for some reason the company incurs a loss for the current year. If there is a company which is a loss making company, or for some reason that company incurs a loss during the current year, then what would happen is you will not be applying the P ratio based valuation to that company. Why? Why is that so? The reason behind that is the P ratio is applicable to. The P ratio is applicable to a company that actually runs into profit. If the company runs into the loss, that means you will have a negative share price, and that is practically not possible. That means you will have a negative share price, and that is something that is practically not possible. So you just need to make sure, and you just need to understand this thing, that basically the share price, even if you get this share price wrong, I repeat, I mean, if the company is in the losses, then what happens is you need to make sure that you don't apply the P ratio. Why? Because you apply the P ratio to a company that runs into a losses, you would get a wrong value. You would get a wrong share computations. Okay, now let's move a bit forward. I had one of the question in the exam, will we be given a P ratio, or you would need to calculate. I mean, it could depend upon the scenario. They might give you a proxy company. You might have to establish the proxy company's P ratio. The other income based valuation method is the earnings yield method. The other income based valuation method is the earnings yield method. I repeat. And when we talk about the earnings yield method, the earning yield is what? The earning yield is your EPS divided by share price. So if you have to establish the share price out of it, you would simply say the share price is going to be your EPS divided by your earning yield. Now, what is the approach that we shall be using for the earning yields? So it's going to be the same as the P ratio based valuation. I repeat, in order to calculate the earnings yield approach, you would have to use the same method as the P ratio based valuation. What do you mean by P ratio based valuation? So the P ratio based valuation would mean that, I repeat, when we use the earnings yield method, so with respect to the earnings yield method, you need to make sure that you use the same approach as the P ratio based valuation. That is, you have to identify a proxy company, you have to calculate the proxy company's earnings yield, and then you would have to adjust the proxy company's earnings yield, and on the basis of the adjusted earnings yield, you need to calculate your own company's share price. Okay, so now let's move a bit forward and let's talk about the next aspect, which is now termed as the cash flow based valuation. The next one of them is termed as cash flow based valuation. When we talk about the concept of cash flow based valuation, always remember that the cash flow based valuation is like that the value of a business is present value of future cash flows. Value of a business is present value of future cash flows discounted using. Value of a business is the present value of the future cash flows discounted using market rate of interest. So if I need to calculate the value of a business, the value of a business is going to be the market value of a business. The value of a business using this cash flow based valuation is going to be what? It's going to be the present value of the future cash flows discounted using market rate of interest. The present value of future cash flows discounted using market rate of interest. Is that okay now? Now, so amongst the cash flow based valuation, there are different methods that we use. What are those different methods that we used? You can either value using the dividend valuation model. What you can do is that you can either value using the dividend valuation model, and the other approach that you can adopt is the free cash flow based valuation. What is the second approach that you can adopt? It's actually going to be the free cash flow based valuation. So there is another approach that you can adopt, which is called free cash flow based valuation. So again, the value of a business is the present value of future cash flows. Discounted using what? Discounted using the market rate of interest. And in order to establish the value of a business using future cash flows, you need to make sure that what are going to be your future cash flows. The future cash flows could be established either using free cash flow, or the future cash flows could be established either using the dividend valuation model. Now, and what exactly is this dividend valuation model? So with respect to dividend valuation model, the formula is P naught is equivalent to D naught 1 plus G divided by KE minus G. We have already discussed this formula when we talked about the weighted average cost of capital, but still, I could just write down the components of the formula. The D naught is the current dividend. The G is the growth rate of dividend. The KE is the cost of equity. The KE is the cost of equity, and this P naught is going to be your current ex dividend share price. It's going to be your current ex dividend share price. Let's move about the next thing, which is the cash flow based value, the free cash flow based valuation. So you can have the two different types of free cash flows. One of them is called free cash flows to firm, and the other one of them is termed as free cash flows to equity. When we discount using the free cash flows to firm, so we discount them using WACC and we end up getting the value of a firm. What do we end up getting? We end up getting the value of a firm. And when we discount these cash flows using the free cash flows to equity, so we discount them using KE. And what do we end up getting? We end up getting value of equity. What do we end up getting? We end up getting value of equity. So I repeat, what happens is when you have got the free cash flows, the free cash flows could be free cash flows to firm. The free cash flows could be free cash flows to equity. And when we talk about the free cash flows to firm, or when we talk about the free cash flows to equity, so this is something that you would have to keep in mind. I repeat, this is something that you would have to keep in mind. And what is it that you would have to keep in mind? That it would depend upon that what type of cash flows are available to you. And on the basis of this, you would actually be valuing the business. So if it's free cash flows to firm, then it has to be considered as value of a firm. Value of a firm actually means the value of debt plus the value of equity. And if it is free cash flows to equity, then it has to be discounted using KE. And the discounting using the KE would actually mean what? I repeat, the discounting using the KE would actually mean what? Discounting using the KE would mean that you end up getting the value of equity. I repeat, what would this mean? This would actually mean that you end up getting the value of equity. Is that okay to everyone? Okay. So what we are going to do now is that we're going to keep our session of today till here now. We are going to be discussing about the exam questions pertaining to the valuations in our session tomorrow. And the tomorrow's session is going to be an extended session where my target would be that we should do at least 3 past examination questions, and so that we could have a good application of the mergers and acquisition. So in case if anyone has got any questions up till now, do let me know, or else I'm going to conclude it here.